It's a Ladies Friday once more on the show, so welcome as we continue to celebrate women during the month of August. Now, we were planning on having a ladies get together, we were planning on having a party, a couple of glasses of wine, and all of that's been thrown out of the window because there's been a huge wobble in the global markets today. But guess what? These ladies are experts in that space as well. So they're going to be here helping me, helping us make sense of what's happening in the global markets. Is this a crisis or is this just a correction? And bringing their insights into the conversation is Mia Kruger. She's a director and fund manager at Kruger International, and she's going to be making sense of the equity sell-off that we're seeing across the board. Sanelisiwe Gantsho, she's an economist at WDB Investment, helping us unpack a lot of the macro issues that are driving the negativity into the markets. And Mpumi Maesela, she's an investment executive at WDB Investment Holdings. And she's going to help us understand how all of this blood on the markets that we're seeing means for your investment strategy. So do stay tuned, and we're going to get into it in a moment. Now, before we get into our conversation, let's take a quick update of the global markets and see what those numbers look like. If we take a look at the Dow Jones, still trading negatively, that's more than 1.5% weaker. Over in Europe, the FTSE is following in even heavier losses at 2.8% weaker. S&P 500, again, almost hitting a 2% weakness today. The Nikkei, using that as our proxy for what's happening in the Asian markets, almost coming in at 3% weakness today. And we've seen a lot of losses being chalked up during the week. Let's quickly take a look at the emerging markets now and see how they're holding up. No surprises there that the emerging markets are being clobbered. Russia, more than 4%. Brazil also at negative 1.5%. And of course, Mexico also following that negative Q at almost 2% weaker. Let's bring it home. Let's take it to the JSE and let's see what that picture looks like. Negativity on the JSE still below 50,000. In fact, we hit the 49,000 territory yesterday, and we're continuing with that weakness, almost 1.5% weaker. And a quick look at the sectors, we're seeing it's negativity across the board. The financials leading in that particular one at 1.65% in terms of their weakness. Let's pull up the commodities. Let's see what that picture looks like. And if we pull up the commodities, gold is laughing all the way to the bank. Perhaps the one spot of positivity, of course, making itself felt as one of those safety haven assets at this time, stronger by almost 0.4% in 1,158 territory. Platinum pulling back just slightly. Yesterday, platinum was up on Q with gold, but today taking a negative dive at almost 1% weaker. And of course, it's that Brent crude price that's been making everybody so nervous today, flirting with $40 at some point, or towards $40 at some point in the day today, although now sitting at 45, 46. The reading still shows that it is 2.5% weaker across the day for Brent crude in totality. So that's your global and your markets picture in a snapshot. And this is the wobble that everybody is talking about, and the ladies are here to make sense of it. Mia, let's start off with you. You watch these markets on a daily basis.
I do.
When you see a day like this,
so I think yesterday we've already seen the Dow down by about 4% in the S&P. So they're heading for the worst week since 2012 this week. So it seems like there was a bit of an unnerving when we saw the data coming out, the manufacturing data from China this week. It was lower than everyone expected. We've heard from the FMOC committee that they are actually, the chances of rates increasing in September is getting slighter. So it seems like it's being pushed out a little bit later in the year, and all of that kind of worries the market. The market was expecting the Fed to hike rates now in September, and they're actually seeing this as a worrisome sign, as if the Fed is worried about the economic growth.
So multiple factors. So there's China, there's the Fed minutes that came out. But here's my question. Is this a crisis? Or is this a correction? Should we be worried about what's happening here?
Well, Nozi, we know where markets are sitting at. Everyone's been nervous about the levels of the markets for the last year. So it's not something new. I'm not going to call whether it's a crisis or whether it's a correction. You better be ready for what's coming. So whenever there's sort of volatility in the market, and we've seen the volatility the last while, it's been high. So we just know the prices are sort of
I don't know. I'm not getting comfort from
no.
You better be ready for what's coming. I mean, that really sounds a bit unnerving. Sanelisiwe, let's maybe go back to the macroeconomic picture. I mean, Mia's already touched on China. We know there was the Greece issue also coming into play. Just paint the landscape for us. What are the big global factors that coming together lead us to a day like this?
So the big global factors is the decline in the Chinese economy, really driven by the PMI number that came out, showing a contraction. And these are the facts. The Chinese market is the second biggest global economy. So when it's actually, when I was actually looking at the numbers, it feels like, you know, this feels like a USA sort of scenario. When they sneeze, everybody gets a cold. So that's what's happening. We're all getting a cold. But in technical jargon terms, the global demand suffered, the decline in global demand suffered within China. That has resulted in the decline of the PMI numbers. So it's largely driven by China.
And what about the US? I mean, maybe Nelly, paint the picture for us of what those Fed minutes actually revealed, because everybody's looking to the Fed decisions and the minutes to give us an indication of the strength of the US economy. So what are we saying about the US economy in the broader scope of what's happening today?
So the minutes are minutes, and it's a minutes in any meeting. So the information, the main information that has been drawn out from your previous guest is the fact that the chances of an interest rate hike in the United States is adding to the jitters that the cold from the Chinese economy has brought to the fore. So that's the main key takeaway. Domestically, we have also that. Domestically, it feeds off the looming interest rate hike that, well, we've had an interest rate hike, but further interest rate hikes to follow. So those are the main key takeaways from those minutes.
So Mpumi, I want to bring this back because you're an investment executive and you are advising people on a daily basis about their investment strategies. Do you look at the kind of nervousness on a day like this, or is the approach far more long-term? If you take a look at what happens today, it's happened before. We've seen it in 2008, we've seen it in 2009. So what's the approach on a day like this?
The approach is just not to panic, because normally what happens is when you've had a strategy as a business to invest into a business or a corporate, you would have invested into the business fundamentals of that business. So the business fundamentals, they have not changed. Yes, we know this is what's currently happening globally. As Nelly was saying, if China sneezes, we all get a fever. But for the markets as it stands, they will continue to have the ups and downs like the weather. It's always going to, every now and then, be volatile. It's always going to be every now and then uncertain. We are living in uncertain times where we don't know what's going to happen. And so you need to have a defensive strategy around who you are going to be investing with and back that investment.
So I want to get into that defensive strategy because I think it's quite important. But Mia, I want you to take on the point of you've invested in the fundamentals of the company, so the volatility you really should consider as noise and not really pay attention to it. Apple shares tumbled more than 2%, simply on a report that's come out that growth coming out of China is expected to be weaker. So help me find my understanding in this analysis.
Okay, so I mean, you mentioned Apple, and then when we look at Netflix came down by more than 5%. So it's big moves for these big companies, and all the companies, I mean, if you look at all the sectors within the S&P, they were down yesterday. So it's been a sharp sort of move in the market due to all the economic drivers. But I think if you consider what Apple's doing and how they, how they do business, how they've always done business, and what they do, the exciting products they offer, how people are loyal to the brand, etc. That's what you're actually investing in.
So you're in essence quite backing up what Mpumi is saying,
absolutely.
That focus on the fundamentals and not so much on the volatility. But Nelly, I want to come back to the macroeconomic space. Surely it's difficult to focus on just the fundamentals, especially, for example, if you are in the emerging market space. There's the issues of the devaluation of the Chinese currency and that possibly triggering a currency war, and emerging markets just being under pressure in general. So those who are invested in emerging markets, is this a different kind of read of the situation that they would have now?
Look, it's not necessarily a different kind of read, but for the fact that the emerging markets have a strong tie, or rather differently put, a a strong sort of, they're strongly influenced by the Chinese economy. So this is where the fundamental issue becomes fundamental, no pun intended. But the fact that we are actually analyzing the PMI, which looks at the manufacturing health sector of China. So this entire conversation is about fundamentals. We cannot ever discount fundamentals based on that point. Secondly, the emerging markets are, look, it's still a, emerging markets are emerging by the main definition of them being emerging, and they're not the developed economies. So they are more they're more sort of responsive to these major this major data that's come out of China. So
there's a sense of great elasticity when it comes to their exposure to global headwinds, if we can put them like that.
Yes, you can definitely put it like that, because they just have that fickleness about them if you compare them to the developing economies.
So let's come back to the local markets, and I want to come back to you, Mia, because I think this is a question I'm building up for Mpumi. So we talk about Apple and Netflix and all of that, and we look at the JSE. It's more or less on track with what we're seeing on the global markets front in terms of the weakness. People are invested locally at this point right now. Where should are there opportunities that are coming out of this weakness that they should be tapping into, and other areas that they should be getting out of?
Well, I think there'll always be opportunities when you see a wobble in the market and when you see volatility. So the thing is that the majority of our exchange is actually hedged against the rand, because we see the majority of earnings from the larger companies coming from offshore. So when we see dollar strength that we've seen and rand weakness, it will actually benefit those companies. And if you're investing for the long term, you want to buy into companies with good growth stories. Like Mpumi said, you want to actually be invested in companies where the fundamental drivers of the business is still intact, and we actually believe that would be the case for the longer term. When we look at the companies in the top 10, just for instance, I mean, there we've got Naspers, we've got Steinhoff, and it's interesting companies that have performed particularly well. Even Standard Bank, when you look at what they've done and how they move into Africa, how they're exposed on a global scale, and how they've got a lot of their earnings sort of protected against rand weakness. And I mean, everything that we just talked about on the economic scene is supportive of a strong dollar. So even the fact that the one is devaluated against the dollar, it's actually supportive of the dollar even further. So all of that is negative towards emerging market currencies, and that benefits the JSE.
So the question I've been building up for you, Mpumi, when it comes to your investment portfolio, does a scenario like this make you want to lean more towards investing in equities or away? Do you protect your investors away from this kind of wobble and the kind of nervousness that it brings, or do you say this is a healthy kind of correction or movement in the market, and this is where you should get in and trying to make your money?
So I mean, it depends. If you're looking at the SMMEs in South Africa, which would be predominantly not listed on the JSE, and the smaller businesses that we're trying to build as a country. So those are the people that would be hard hit if a situation like this lasts longer, because then the spends that you expect to be coming towards their businesses gets reduced by the bigger corporates. So for me, there's a bigger question and there's a bigger story that we need to look at as South African Inc. in terms of what would be the fundamentals that the small businesses and the mid-cap businesses build on to be defensive and resilient in their own right as small businesses and as striving businesses when situations like this happen.
So fundamental questions, fundamentals for fundamentals, as Sanelisiwe put it so eloquently earlier on, are really at the core of the conversation we're having now. We're really trying to make sense of the global sell-off in the equities market, and Mia bringing some really strong insight there. Sanelisiwe trying to really bring in the Chinese issue, juxtapositioning that against what's happening in the US. We're going to go to Greece when we come back. And of course, the new angle of the conversation that we need to look at that Mpumi is putting on the table is there's a bigger story here. Yes, we can talk about listed companies, but the economy is dependent on the smaller and more medium-sized companies. So how do we build their resilience and how do we make their fundamentals even stronger when there is a wobble of this nature? Trying to make sense of the wobble in the global markets that has everybody consumed, trying to make sense of which way is up or down. The ladies are helping me and better understand all the issues that are around this. So before we get into the conversation again, I thought it would be important for us just to look at the variables or the various parts that led us to where we are today. I'd like to call it the journey to the eye of the storm. And I think that's what you're seeing on your screen now. So you remember there was that Chinese summer sell-off that like wiped off almost a third of the value on the stock exchange. Then there was the devaluation of the yuan, and that was cueing a currency war, according to many analysts. The Fed minutes that we were speaking about with Sanelisiwe in a moment, how they've come out and rocked the markets and exposed weaknesses in the US market that others really didn't think were there. Drawing lots of questions around the timing of a rate hike. In fact, I think the number has moved from 45% in favor of a September rate hike down to 24%. Lots of questions there. And one of the issues that we're going to get into now, of course, is the Greek Prime Minister and his shock resignation. What is the impact of this political move? And of course, it's the Chinese factory data that came out today and bloodied the markets across the board. So those are our data points almost leading up to where we are today. I want to maybe start off with Greece. Tsipras resigns. Many are saying this is a really astute political move because he's likely going to come back and without much of a challenge and be reinstated. From a market's perspective, does this matter?
So from a market's perspective, it adds maybe, let's say, 90% assigned to China and 10% assigned to Greece.
Yeah.
It's worthwhile news, but it's not the reason, the primary reason why we're sitting here today talking about one of the worst weeks in the markets in the world in history. So that's the context where Greece fits in. I'm glad you mentioned that it's a political move because politics is very much linked to how economics is implemented, because it's the politicians that implement the economic policies or lack thereof.
Yeah, or the lack thereof. And I mean, it raises lots of questions around the Chinese also trying to manipulate the markets and so on. Your take on Greece and Tsipras and this political move. Big deal, no big deal?
Well, I think if you read books like Tipping Point and, those sort of things, then you understand that it doesn't matter the significance of a factor that can be the tipping point. It's just another sort of add-on when it comes to the negative sentiment around the market. So we've had the Chinese story that's been coming for quite some time. We've known that the Chinese economy is under pressure. We saw what the People's Bank of China did around the yuan, and we saw, the trouble that we saw from the earnings sort of perspective from the US of all the multinational companies with a strong dollar, and we know what's going on in commodity prices. So all over, it's been sort of a negative undertone in the markets, and then we just hear sort of all these things that happened this week. So it could be any sort of thing that could be the tipping point for the markets, and I think this is sort of what we're looking at the moment.
Sort of what we're looking like. So for the average South African who is maybe not invested on the Johannesburg Stock Exchange, but is constantly aware of the headlines around Greece and what's happening in Greece, and they wake up today to the fact that the Prime Minister has resigned, does this matter in the bigger scheme of things in your investment strategy? Are you going to be looking at what a small economy like Greece, although in a bigger, more important union, is doing?
So like Nelly was saying, it does cause jitters, but for me, anyone who has some investment and is hearing this, the first thing that they should do is speak to someone who's more informed to get proper advice around what's going on. So do not panic. Call your advisor if you have some investments and you're worried in terms of how your portfolio is performed. Call your broker to try and understand and make sense of things. It doesn't really assist the situation to try and get out of your investments when the market is at the lowest. It's always advisable to just find out what can be done. Maybe like Mia was saying, it is an opportune time to even look at more exposure in terms of those stocks that would have fallen if you are exposed in the JSE. If you're not exposed in the JSE, you would have people who would have been looking into the portfolio, if it's a unit trust, for example, who would then be able to see if that type of investment, does it need to be re-looked at in terms of the mandates? Are there stocks there that now needs to be exited because it's no longer meeting the investment mandate of the actual fund itself?
Nelly, I want to bring you in on the Brent crude drop that we've been seeing as well, because I think it links very nicely to what Mpumi is talking about, because there's also a very strong link between direct impact on the consumer with what happens with Brent crude. We saw today really, really low levels, almost flirting with $40. People are asking whether this is a repetition of 1986. I don't have the answers. What do you think of that movement, and what do you think the impact on the consumer in South Africa is likely to be?
Again, the repeat theme of China having almost a common denominator in every conversation and talking point that we're going to have. So it's a decline that, where analysts have last saw it in 1986, if you mentioned. And I was going to quote you because I like your use of words and flirting with those lower sort of numbers. Yeah. And I think that's going to, the link to the consumer is obviously very much welcomed. Here in South Africa, domestically, we're going to experience a petrol price decline, mainly actually attributed to those international prices. So that's the basic link. The international prices go up and down given whatever political sort of situation is affecting those numbers. So that's the consumer link, and the consumer would welcome it, at least from a South African perspective.
Consumers are going to welcome it. Where do you see the oil price going? And I mean, I know I'm asking you to look into a crystal ball, but general direction, are we going to tread back towards $40 a barrel, or is there going to be some recovery just looking at the oil market play right now?
Well, Nozi, we know there's an overproduction, and OPEC is very clear about that. They're not going to stop producing, so we're not going to see anything that supports the oil price soon. I'm not expecting that, and I'm thinking that the very sad sort of case is that the South African consumer has not seen a lot of benefit when it comes to the lower oil price. Last year we had a significant decline in the oil price already, and unfortunately locally petrol prices have been influenced by higher tariffs, higher sort of taxes, etc. So unfortunately locally the consumer sees very, very little of lower oil prices. We will be seeing a petrol decline, but I mean, sitting where we are at the moment, it's going to be, you know, it's sort of just a little thing that we can benefit from. It's not going to change the inflation rate in the country. Even when you listen to the monetary committee here and you listen to what they're saying and where they're seeing inflation, they're probably seeing inflation. Well, they say they're seeing inflation around the end of the year around and over 6%.
Yeah, and we're currently at 5%.
Exactly. So you know, they're actually not seeing a benefit. Unfortunately, when the rand declines against the dollar, then it's more negative towards our economy because we're an importer nowadays, and we don't really see the benefit of all that oil lowness, unfortunately.
Well, there we have it. It's women, it's wealth, and I think for me anyway, it's been tons and tons of wisdom all packed into 30 minutes. A very, very big thank you to my guests. Really, really awesome insights from a feminine perspective, making sense of what's happening in the global markets today. It is a shorter show because we are going to be crossing over to international programming, where more analysis of what's happening in the global markets is going to be coming your way. But that being said, a big thank you to Mpumi Maesela. She's an investment executive at WDB Investment holding Sanelisiwe Gantsho. She's an economist at Liberty Investments, and Mia Kruger, director and fund manager at Kruger International.